guys, Ryan Stevens here with Mortgage Shots of the National Real Estate Post. Hope you're all having a great day. We got Wednesday. We have pods tomorrow. That is our crowdsourcing group. And I want to thank everybody who was on pods this last Tuesday. Man, we got a lot of ground covered. Loan officers, if you want to join this, it's a crowdsourcing group of LOs across the country. And what we do is we find solutions to the things that bother us all. All you have to do is fill out the information down below and we'll get you dialed in with that. So where are we at right now? We got a whole bunch of stuff that we're going to cover today. Rates are in the news again. Rates are always in the news. But right now we've got a different twist on things. So let's jump into everything right now and find out what things look like. Well, the first one that I want to look at here, this is from Fortune magazine, Warren Buffett, Berkshire Hathaway, and even Zillow. So because Zillow said it, we know that we can't second guess this. They say mortgage rates cannot fall enough for Americans to afford homes right now. How do you feel about that? Do you think that's true or not? They can fall far enough. They certainly can fall far enough to where people could afford them. The question then becomes, do we have the intestinal fortitude to see home prices drop as much as they need to in order to bring back stability? Okay, and here's the first point. This is precisely what I'm talking about. The Fed right now is preparing to pivot its balance sheet with potential ripple effects that are going to affect mortgages. What are we talking about here? Well, what the Fed is going to do, and frankly, this is what got us into the mess in the first place. It's called quantitative easing. So when we figured the economy was going poorly, the Fed decides to come in and increase their balance sheet, lower mortgage interest rates below what the market would normally find sustainable in order to make a much more favorable buying environment. Oh my God, the market is about to hit the skids. Well, let's go create artificially low interest rates. People will continue to buy houses and we can keep this economy propped up. And I find this politically expedient for me and my party. This is what we've seen take place. The growing number of economists believe that the Federal Reserve is close to announcing the end of quantitative tightening programs, a move that could have wide-reaching implications for the mortgage industry. Over the past few weeks, central bank officials have signaled that they are prepared to wind down the policy aimed at shrinking the Fed's balance sheet, prompting expectations of an announcement as soon as Wednesday. Earlier this month, Fed Chair Jerome Powell said that winding down the QT could happen in the coming months, while other officials have shifted their language from describing reserves as abundant to ample. The Fed's balance sheet has expanded dramatically over the past decade, doubling from about $2.2 trillion to $4.2 trillion in 2020, just before the COVID-19 pandemic. Guys, this is what's taking place here. We are printing money. We are increasing our debt load with the Federal Reserve on their balance sheet. We're doing this by buying mortgage-backed securities. We've covered this ad nauseum on our show right now. What they've done is they've done something called quantitative tightening. They're going to go back to a quantitative easing policy, which is going to bring down interest rates. This is from Lance Lambert, who's a fantastic person to follow if you ever are on X or Twitter. He's got a bunch of great information, but if we look at rates right now, they're down across the board. The 30-year fixed rate, the 15-year fixed, your FHA, jumbo, ARMs, and VA across the board are lower from a day, a week, a month, and a year ago. So again, we're finding relief with interest rates, but mind you, this is a red herring, and I don't think lower interest rates are going to have the type of effect that we're looking for. It is a massive change in policy that we need to be looking at. Here's one of the reasons why. Home prices right now are lagging inflation, meaning homeowners are losing out on their investment. So if you're buying a house right now, again, policies that we've created have a ripple effect and they're creating unintended consequences, a term that I have been using literally for 2 decades right now on all the policies that we've seen from all the administrations over the past 20 years. Unintended consequences. So right now, the policies are creating inflation, and right now we're not seeing the appreciation on properties because we've played that card and people simply can't afford houses at the price we're at right now, yet inflation keeps marching forward. Home prices rose nationally in August, but the growth is weakening and is slower than the rate of inflation. Prices rose the most in the New York metropolitan area in August with a 6.1% annual gain, followed by Chicago, believe it or not, and Cleveland. I got to tell you, I've got a soft spot for Cleveland, especially their mustard-based barbecue sauce that you can get downtown. It is absolutely divine. And finally, the average rate on the 30-year fixed-rate mortgage started June just below 7%, fell to 6.5% by the end of August, and this is according to Mortgage News Daily. Here we go. The National Home Price Index rose 1.5% year over year. What we're looking at, the Composite 10, the Composite 20, and the National Index. And, it's a small, this is a Case-Shiller Index. It's a slight increase, but it's a reasonable one. And here's what I really want to get across when we are looking at this graph. Housing wealth eroded in real terms for the fourth consecutive month, with a 1.5% national gain, falling well short of the 3% inflationary figure that we're currently looking at. The S&P Case-Shiller U.S. National Home Price Index posted a 1.5% annual gain for August, down from 1.6% in the previous month. We've gone from 1.6 to 1.5, and when we're staring at inflation, which is double that, at 3%, even though these numbers may seem small, it is double. Inflation is double what our national gains are. And that number right there should put some red flags up when we're looking at the housing market. And here's the thing. The housing market is a $7 trillion industry. So if you take 1.5% upside down of a $7 trillion industry, you're talking about billions, not millions. The S&P Case-Shiller National Price Index, covering all 9 U.S. consensus divisions, reported a 1.5% annual gain in August, down from 1.6. As I just told you, the 10-city composite showed an annual increase of 2.1 from 2.3% the previous month. The 20-city composite posted a year-over-year increase of 1.6, down from 1.8 in the previous months. Translation, this is something that's kind of been with us, but not really talked about for a couple of years now. And now that it's coming to light, we're probably going to see a bigger disparity based on the policies that we have right now between inflation and price appreciation. One, we can't afford the appreciation because we can't afford the houses. And two, our policies that we have in place right now, our monetary policies, are going to guarantee that inflation below 2% is something that is not going to be realistic without a massive and total transformative change. Here's something to really check out. This is from Nick Gurley, my bad. Austin, Texas home values are down 20% from the peak, and that was back in 2022. The peak was at 539,000. You notice that we've gone back to what really looks to be a more normalized appreciation flow. We saw that massive peak over there in 2022 when it was 538,000, and now we're back down. This is what we're seeing with Lennar, and this is what we're seeing in all of our top 20 major metropolitan areas. Why is it important that we're talking about areas like California, Texas, and Florida? Florida, Texas, and California are a huge part of our economy, but they're also, they're the trend setters for what the rest of the country is going to follow. And frankly, the rest of the world is going to follow. So here's the reason why we're talking about Florida, Texas, and California. So this is half of the entire world's gross domestic product. It's in 3.6% of the land area. When we go to North America, look at what it is. It's Florida, it's Texas, it's California. We are an enormous portion of the bloodline of the world. What else is going to be affecting interest rates? Here's something that's, well, not terribly interesting, but did you know that UPS announced that they're losing 48,000 jobs? They terminated them in 2025, 48,000 jobs. If they're losing 48,000 jobs, is this from AI? Maybe a couple of jobs that AI is not driving these cars just as of yet. I'm sure they will going forward. 48,000 jobs is a massive number, but it's symptomatic of a larger problem. It's not the 48,000 jobs that we lost. It's what they do for a living that counts. They are producing the things that represent our GDP, all of our manufactured goods, the lifeblood of our economy. Those that carry the lifeblood of our economy are truckers, UPS, FedEx. When they start dropping jobs, they're dropping jobs because people simply aren't consuming as they have in the past, and this is going to have a ripple effect on the overall economy, and it ultimately leads all the way back to the housing market. And you're seeing the exact same thing happen with other companies that have the same type of ripple effect. Amazon targets as many as 30,000 corporate jobs. You know, we see those UPS trucks, we see those FedEx trucks, we also see those Amazon trucks too. So we're losing 48,000 over at UPS, we're losing 30,000 over at Amazon. Are you starting to see the trend that's taking place here right now? As we are having a little hard go of it, would it surprise you to hear that JPMorgan Chase and Jamie Dimon just came out yesterday, who just went bankrupt? Jamie Dimon is coming out and talking about this and trying to downplay it. In the meantime, they just opened up a brand new $3 billion headquarters at 270 Park Avenue in New York City. I think the optics on this one are not terribly good. All right, I'm going to move on with these here pretty quickly. By the way, some good news here. Did you know that on an individual basis that the United States still has the healthiest GDP in the world? What does it say for the rest of the world right now? When we look at the GDP per capita in our country's gross domestic product divided by its population, this data is adjusted for inflation and differences in living costs between countries. In other words, we take our GDP, we take the 370 million people who live in this country, we divide those numbers to see how much you represent of the GDP. The United States is still at the top of the game. Look at how many stocks are being shorted this year. We are shorting stocks in a manner that we have never, ever done before. This is investors betting against the economy. These are institutional and professional investors who are telling like the plebeians like myself and you that we certainly have a recession in the near future. I probably put this one earlier. This should go with UPS and this should have gone with Amazon, but we look at freight volume. Our trucking is down 17%. Again, the lifeblood of what is produced, what is purchased, and what is sold. It is the commerce of our country. It is all on rubber tires and highways. And anyone who's got rubber tires and highways right now that are the lifeblood of the economy, well, it is across the board down, which makes this graph right here, betting against the economy, seem like a pretty good place to be. In short, you still have complete and total self-determination with the outcome of what you do and where you are, because I speak with loan officers and realtors every day, and I'll tell you right now, I find a ton of people finding pockets of success, and I unfortunately find other people who can't figure out which direction's up. So buckle down, just keep your nose to the grindstone right now, put your boots on, all those cliches, and those who do always succeed, where those who don't, never. With that said, you guys make it a great day, and I can't wait to see you until tomorrow here on Mortgage Shots in the National Real Estate Post.